Hi, Doctor. Here's Ren Jing. My topic is China's equity refinancing performance analysis based on the information technological industry. Let me first introduce the background. Um, Financing is an inevitable process of enterprise development. Financing behavior is also a common phenomenon in the capital market. Chinese listed companies often like to use equity for financing when they make external financing. The vast majority of listed companies prefer to perform equity financing, which is contrary to the pink theory established by Western capital market. In terms of the development of information technology, the different lifestyle brought about by information technology after the 21st century have penetrated into all aspects of human society. For example, the difference that mobile phones bring to people's contract, the difference that the internet brings people access to information, and so on. The information technology industry is a high-tech industry and has made a huge contribution to the development of social economy. The problem I need to study is that current research results show that a large number of research results of Chinese scholars attribute the financing tendency of Chinese listed companies to the low cost of this financing method. So in the current situation where most listed companies prefer equity financing, does the does the performance of equity financing match this performance? In fact, the result of China's research on equity financing performance show that performance for equity financing for research allocation is not an efficient choice. On the contrary, the performance of equity refinancial is low, and the profits that can be brought to the company are very limited. Okay, next is the research objects. The main object of this paper is to analyze the performance of equity refinancing in China's information technology industry. Specifically, it's divided two parts. One, discuss the current situation of refinancing in the information technology industry, analysis its tendency and the influence of it, and analysis the factors that from this performance. And two, chose different indicators to compare the performance of different financing methods. The main indicator used in China to measure whether a listed company has equity refinancial performance is ROE. Therefore, in terms of long-term performance, this paper chose to use return on net assets to measure it. In terms of short-term financial performance, the abnormal rate of return is used to analyze its performance. The research problem of this paper is in the current market performance, the equity financial performance of listed Chinese information technology companies is very significant, and the overall phenomenon is biased towards equity financing, but the proportion of debt in the capital structure is low. Such a large amount of equity financial is not commensurate with the company's operating performance growth. The behavior doesn't bring about the reasonable allocation of research. This paper used listed company in China's information technology industry and the simple to study the performance of equity refinancial. Okay, next page is the main literature review, which you can see here. Most research results show that the performance of equity financial is not particularly good. So why does China's information technological industry prefer equity financial? This is a question to be studied in this paper. Okay, next is the research method. First, I will explain a few concepts. First, the Peking theory refers to the sequence of 1. Internal capital, 2. External capital, 3. Indirect financing, 4. Direct financing, 5. Bond financing, and the last one, stock financing. When a company raises funds, second, the shareholding structure and share splitting ownership structure refers to the number of shares with different attributes divided by the total number of shares. That is the proportion of related shares in the total stock, and also what kind of relationship exists between those different shares. That is which shareholder hold the company's shares and how much of the company's total shares are held by him. And then the so-called equity split. It refers to all the stocks issued by the company on the stock exchange, some of which can be freely traded on the stock market and traded in public. The third is the abnormal rate of return, which reflects the comparison between the actual rate of return of the security and the expected rate of return of the security. Here, the difference between the two is called the abnormal rate of return, the relationship between securities and the market. The cumulative abnormal return rate reflects the sum of the abnormal return rate of the security over the period of time. Okay. This one is the states of development. As you can see on the picture, with China's policy support and rapid economic development, China's China's electronic information manufacturing industry has shown steady growth. Since 2014, imports and export and profits have fluctuated in a short period of time, but the overall change has been stable, indicating that the electronic information manufacturing industry has passed the initial rapid growth stage and has entered a uniform development. It can be seen from Table 3 that since 2002, the total financing amount of equity refinancing has continued to rise. The most obvious is that from 2005 and 2006, the total refinancing amount has greatly jumped from 32.164 billion yuan to 264.647 billion yuan, more than 8 times. The issuance and allotment of shares approached half of the total market financing in 2004. Since 2005, the issuance and allotment of shares has exceeded half of the total market financing. By 2012, the total amount of additional issuance financing reached 30 342.248 billion yuan, and the allotment was 12.100 billion yuan. According to statistics, this year China issued 156 additional issuance and 7 shares allotment, which a total amount of 447.06 billion yuan, accounting for 79.3% of the total equity financing, compared with 33.62% in 2002. The proportion of equity financing has only risen in the past 10 years. This means that equity financing has a considerable scale in China, and the Chinese listed companies especially perform equity financing in rice funds. Okay. The data in the figure compares the performance of different financing methods by selecting different indicators. The main indicators used in China to measure whether listed company has equity refinancing performance is ROE. And in terms of long-term performance, this article chooses to use return on net assets to measure. In terms of short-term financial performance, the abnormal rate of return is used to analyze its performance. A total of 18 companies were collected in the sample. First, discuss empirical research on short-term performance based on abnormal rate of return. List companies will with a cumulative return greater than zero that implemented additional issuance in 2014 accounted for 27% of the sample, and the average abnormal cumulative return was 0.0021. Yes, which was significant at the 5% level and passed the significant test. The fact is also that the market share price performed well in 2014, and the stock price continued to rise. Listed companies are very enthusiastic about issuance and allotment of shares. The market has also bought a considerable rate of return. Most investors have no obvious negative reaction to the issuance and allotment of shares. In 2015, the proportion of listed companies with cumulative returns greater than zero for additional issuance accounted for 39% of the sample, and the average abnormal cumulative return was negative 0.08372, which was significant at the 5% level and passed the significant test. In 2016, companies with a cumulative return greater than zero for additional issuance accounted for 46% of the sample, and the average abnormal cumulative return was negative 0.03214, didn't pass the significant test. This year, the market began to pull back. Generally speaking, the listed companies that issued additional shares has not performed impressively in their stock price after the additional issuance. In 2017, company was a cumulative return greater than zero for additional issuance accounted for 60% of the sample, and the average abnormal cumulative return was 0.05342, which failed the significant test. In 2017, institutional investors had considerable impact on A shares. The high risk of the stock market discouraged the individual investor. In 2018, companies with cumulative returns greater than zero for additional insurance accounted for 60% of the sample, and the average abnormal cumulative return is the 0.00066, which passed the significant test and is significant at the 5% level. Okay, and the next is the empirical analysis of long-term performance based on return on net assets. You can see the result on the picture. Let me explain the meaning of this data. In 2014, the average return on equity of the simple company in this year of the issuance was 2.01%, and the return on equity in the second year of the issuance was 1.19%, a decrease of 0.08%. The return on net assets continued to decline in the third and fourth year, and the fourth year was 0.76%, lower than that of the additional insurance. Look to the 2015. The average return on equity index still declined from 1.12% in this year of the additional insurance to negative 2.33% in the first year, a year-on-year decrease of 3.45%. In 2016, the overall trend still shows a downward trend, with 2.65% in the first year of additional issued and 1.18% in the first year. 2017 also showed the downward trend, although the second year of additional insurance. A second year is the T plus 1 year. Second year additional insurance slightly increased by 0.03% compared with the year of the additional insurance. And the overall level was still a downward curve, and the first year of the additional insurance was lower than the year of the additional insurance, 0.99%. 2018 still showed the same trend as other years. The average return on equity in the year of the additional insurance was 2.24%, and by the fourth year it was only 0.46%, a year-on-year decrease of 1.78% from the data point of view. After the additional insurance, the return on net assets of the sample companies has shown a downward trend, with different degree of decline in different years. This shows that the long-term performance of the sample companies is affected by the issuance of new shares and is negatively affected. Okay. The conclusion of whole study is simply that although Chinese-listed companies tend to choose equity financing, the results of choosing this method are not impressive. In the short term, the company additional insurance or allotment is not welcomed by investors, especially if the company that makes this behavior when it comes to new project. In the long run, the company's long-term profits will decline due to the choice of this financial method. Okay, that's my conclusion and presentation. That's all for me. Thank you, Doctor.